Thanks for joining us this Tuesday, Peter.
Yeah, nice to see you again, Daniela.
Peter, it started off as a quiet Veterans Day, but now gold pushing higher and sets a daily high on short covering and a weaker US dollar index. And kudos to you, Peter, because last week you were saying that if gold could hold 1137, we could see these pops in the market. We saw it Friday, and we're seeing it again today.
Yeah, sometimes you get lucky. The market was just massively oversold last week. And when Friday's employment numbers came out, they weren't bad. They weren't stellar. So they were slightly on the low side. And, you know, that was just enough incentive for the bears and the shorts to run for cover. They ran for cover on a Friday, thin market. And the rally that we thought would develop came in force and pretty dramatically on Friday, with gold adding $50, almost getting up over the 1180 level, and silver trying but not quite reaching the $16 mark.
Now, Peter, why do you think these rallies might have trouble holding? We saw it on Friday, it was a short uptick, but it didn't hold. Monday was a quieter day, and now we're seeing this pop today.
You have to look at it from a trend perspective, and in all fairness, when you go back, even go back to 2008 and watch the gold market moving up to the eventual high of 1900. It's never a straight line. It'll run up. $100, 120 in a bull market, and then it'll retrace itself 40, 50, maybe sometimes as much as $70, but the underlying trend still being bullish will then take it up to new higher levels. We've been in a bear market cycle for about 2 years now, and the fact that gold broke down through the 1183 triple bottom a few weeks back caused aggressive selling, brought it down into the low 1100s, and there were a lot of people that were short there. So it's to be expected every once in a while within a trend that you're going to get a counter trend, and that's what we saw Friday. Basically the shorts just being a little cautious and running to the exits, and in a thin market you get the pop. But then you again identify the underlying trend, and the fundamentals have not changed. The U.S. dollar continues stronger, and so you get the selling that resumes, after the rally fades.
And just on the note of the US dollar, Peter, I'd just like to bring up the importance of the dollar when we're speaking gold, because it really seems to be the only game in town, because we have the euro suffering, we have the Japanese yen hitting a 7-year low overnight. So it's really a dollar play here when we talk gold.
Yes, I think so, and I think it's been the story for the better part of 2014. And commodities are priced in US dollars. 99% of the world trade in commodities is settled in US dollars, and a stronger US dollar has a negative impact generally on the commodity complex, other than fundamentals getting involved. I mean, you'll see some of the food commodities will buck the dollar trend, but that again is a supply-demand issue. But generally, supply-demand being equal, a stronger dollar will have a negative influence on a commodity complex.
All right, in other news, Peter, let's look at the U.S. Mint, and they will start to resell their Silver Eagle coins on allocation basis next week. This was after last week's announcement that they had to halt sales because they couldn't keep up with demand. What does this tell us about the marketplace right now?
Well, again, once, when we had the breach of silver at $16, there was just tremendous retail demand, specifically for silver coins, both in the Eagle and the silver maple leaf. That was to be expected as we put a new handle on the silver price. What I find a little disconcerting here is, from a bullish perspective now, is that the U.S. Mint runs out of coins a week ago, but all of a sudden is now back on allocation. That strikes me as a very quick turnaround. The mint productions are usually on a 24/7 basis. So for them to be able to right the ship, so to speak, albeit we're still on allocation, within a week indicates that, again, at these levels now, at mid-1550s, maybe these levels have now again seen their saturation point, and some of the volume has dropped off. And it'll take a breach of the $15 handle again to bring in new buyers, which will put pressure on inventory. But should silver, sort of trade sideways here for a few days, and and gold holds sort of the the 1150-ish range for a few days, I think you'll see physical demand drop off and the mints will catch up on their production.
Peter, thanks for your thoughts today. And before I let you go, what will you be doing with gold at these levels now? It doesn't seem there's any fundamentals in place right now to call for a bull rally, except perhaps the Ukrainian situation.
Yeah, the Ukrainian situation could flare up again. There is some talks that Russia's again on the border, and Ukraine is indicating that they're worried about a Russian invasion. So I think that would create some underpinning demand, especially in Europe, for gold from a safe haven perspective. But the fundamentals still look like a stronger dollar, and at least from what we can see, a stronger equity market, which should create and continue to create headwinds for gold. And even from a technical perspective, we need 1183 taken out on the upside to get technically positive, with 1137 again, 1132 to 1137 range being the support on the downside.
Peter, on that note, thanks so much for joining us today.
Okay, thank you. Bye-bye.
And thanks for watching this edition of For Pete's Sake. Remember, next week we will be in the Cayman Islands covering the Grand Cayman Liberty Forum. It's not too late to register and join us there, so please do so at the link below. Thanks for watching.